Green finance introduction. Whether you've seen or been personally impacted by Extinction Rebellion or school strike climate change protests, whether you've watched David Attenborough's BBC or Netflix programmes, or whether you've heard or read the Bank of England Governors Mark Carney or other senior central bankers and financial regulators recently, it's clear that tackling climate change has gained critical prominence in recent months. Natural causes and human activities both drive climate change. But the overwhelming scientific consensus is that human activity has had and continues to have a significant impact. The Intergovernmental Panel on Climate Change's special report, published in October 2018, contains the most comprehensive and up-to-date assessment of the science relating to global warming. It is quite clear, stating that human activities are estimated to have caused approximately 1 degree of global warming above pre-industrial levels. Global warming is likely to reach 1.5 degrees Celsius between 2030 and 2052 if it continues to increase at the current rate. The effects of 1 degree global warming are already visible and include more frequent and more severe extreme weather events, sea level rises and increased flooding, melting glaciers, sea ice and the Greenland and Antarctic ice sheets, loss of biodiversity, and displacement and migration of communities. Limiting global warming to 1.5 degrees Celsius requires reducing emissions of carbon dioxide, one of the main greenhouse gases, by some 45% by 2030, relative to 2010 levels. This seems to be highly unlikely at the current rate of progress. If global warming exceeds 2 degrees Celsius, factors such as melting sea ice and the release of methane currently captured in permafrost could lead to a tipping point of rapid and irreversible climate change with profound environmental and social consequences. That's the bad news. The good news is that we can limit the extent and the effects of climate change. We already have the technologies we need for a transition to a sustainable low-carbon world. Renewable energy, clean transport, energy-efficient buildings, sustainable agriculture, aquaculture and forestry, for example, to limit greenhouse gas emissions. This is known as climate change mitigation. And we are already supporting communities most impacted by the effects of climate change, improving their resilience to rising sea levels and extreme weather events, for example. This is known as climate change adaptation. The even better news is that our financial services sector has a key role to play in supporting that transition. It requires very substantial capital. Estimates of the investment needed vary, but a figure of $6 trillion per year for the next 20 years is a generally accepted figure.